All right, let's just dive right into this explainer, because if you hold any crypto in the UK, the days of flying under the tax radar are officially over. As highlighted in a recent deep dive by Londoner News into HMRC's crypto tax warning letters, the whole landscape for digital assets has radically shifted. We're moving away from this era where crypto kind of felt like a financial Wild West of anonymous wallets, straight into a highly regulated world where HM Revenue and Customs literally knows exactly what you're doing. So if you've been relying on the whole crypto's decentralized idea to keep you safe from centralized tax obligations, you absolutely need to pay close attention to what we're going over today.
81,172. Take a second to let that number sink in. That staggering figure is exactly how many warning letters, emails, and text messages HMRC sent to crypto investors in the 2025 to 2026 financial year alone. They're explicitly targeting people whose records suggest they've sold, exchanged, or received crypto without fully declaring the gains or the income on their tax return.
And this perfectly illustrates a massive 680% spike over just 3 years, going from around 27,000 letters back in 2023 to over 81,000 recently. That proves beyond a shadow of a doubt that this is a highly targeted, accelerating crackdown. Crypto ownership has gone totally mainstream, and HMRC's ability to link investors to their transactions has completely caught up.
But hey, don't panic just yet. In this explainer, we're going to cover the HMRC crypto crackdown, the fiat cash-out myth, calculating your tax liability, the new 2026 CARF data trap, and finally, how to actually fix your tax.
Okay, Section 1, the HMRC crypto crackdown. Let's start with the most immediate problem. What actually happens if one of these HMRC nudge letters lands on your doormat?
The absolutely crucial thing to understand here is that receiving a nudge letter simply means their data shows you might have undeclared crypto activity. It's basically a prompt for you to review your affairs before a formal investigation kicks off. It doesn't automatically mean HMRC has definitely established that you owe tax, and it doesn't mean their suggested amount is spot on either. It's a warning shot across the bow asking you to double-check your transaction history.
Moving right along to Section 2, the fiat cash-out myth. We really need to talk about the single biggest trap that's catching out both casual dabblers and active traders.
Do I owe tax if I never actually cashed out to pound sterling? This is hands down the most common question we see, and unfortunately the answer is a huge resounding yes. HMRC simply does not care if you kept everything on chain. Cashing out to your bank account isn't the taxable moment, disposing of the asset is.
So the key takeaway here is that under UK law, you trigger a capital gains tax event anytime you dispose of a crypto asset. Selling for fiat? Obviously. But swapping crypto for crypto, like trading Ethereum for Solana? The tax man treats that as selling your Ethereum at market value and then buying Solana with the proceeds. Using crypto to buy a laptop or, a pixelated monkey NFT? Taxable. Gifting tokens to a friend? Also taxable, based on the market value on the exact day you gave it away.
Our source material really hits the nail on the head here, calling the idea that swaps are tax-free the single most expensive misconception in crypto tax. Busy traders can easily generate hundreds of taxable events, realizing gains and losses without ever touching traditional fiat money. If you've been trading token for token and thought you were safe just because your money never hit a UK high street bank, well, you need to recalculate your position immediately.
All right, Section 3, calculating your tax liability. Let's look at how we actually calculate what is owed, because the safety net for small-time investors has vanished pretty quickly. This recent trajectory is super painful, but you absolutely have to know it. In just a few short years, the annual tax-free allowance for capital gains plummeted from over 12 grand down to a measly £3,000 for the 2024 to 2026 tax years. That means even tiny minor trades can easily push you into taxable territory. And once you cross that £3,000 threshold, you're paying either 18% or 24% tax on the excess, depending on your income tax bracket.
And calculating those gains is nowhere near as simple as checking your basic spreadsheet. HMRC applies these strict share pooling rules, including the infamous 30-day bed and breakfasting rule. This highly specific regulation stops you from artificially selling an asset at a loss just to reduce your tax bill and then immediately buying right back into the exact same asset. If you buy the same crypto back within 30 days, your disposal is matched to that new purchase, completely ruining basic spreadsheet math and potentially wiping out the entire tax loss you were trying to claim.
Oh, and we definitely can't forget the income side of the equation. If you're receiving staking rewards, most types of mining payouts, or even certain airdrops, HMRC classifies those as straight-up income the moment you receive them, not capital gains. This means you could owe income tax and potentially even national insurance the literal second those tokens hit your wallet. Forgetting this income side is a classic mismatch that HMRC systems will instantly catch, leading to double the trouble if you only declare the later disposals as capital gains.
Which brings us to Section 4, the 2026 CARF data trap. The catalyst for why HMRC suddenly knows so much about your hidden digital wallets is actually quite fascinating.
We're basically transitioning from this before CARF era to a very real after CARF reality. CARF stands for the Cryptoasset Reporting Framework, which is an initiative driven by the OECD. Before this, HMRC mostly relied on manual checks and limited data from UK-only platforms, but starting in 2026, CARF means HMRC is receiving automated, structured data dumps from global exchanges across more than 50 participating countries. They're literally using AI-powered tools like their massive $100 million Connect system to algorithmically cross-reference all this exchange data against your self-assessment returns.
Just consider exactly what is being handed over to them. Since January 2026, major platforms, we're talking Binance, Coinbase, Kraken, are legally obligated to hoover up this precise data. They're sending your name, your national insurance number, and full transaction records, including purchase prices, sale prices, swaps, and your total annual profits directly to tax authorities. So using an overseas exchange isn't going to protect you anymore. If they operate in a CARF jurisdiction, your data is already being shared.
Finally, Section 5, how to fix your tax. The net is definitely closing tight, but how do we resolve this before the penalties start piling up? Let's go through the fit.
If you actually receive a letter, just follow these simple, clear steps. Step 1. Do not panic, and whatever you do, absolutely do not ignore it. Ignoring it doesn't make it go away. It just makes it way more expensive. Step 2. Gather up all your historical exchange, CSV files, and wallet data. Step 3. Calculate your gains correctly using HMRC's Section 104 pooling and those 30-day rules we talked about. And finally, Step 4. You have 12 months to amend a recent self-assessment return, or if you've got older mistakes to fix, you can just use HMRC's Digital Disclosure Service.
And hey, while you're getting all your records in order, remember, you can still legally optimize your position moving forward. As our sources point out, you can actually transfer crypto to a spouse or civil partner completely tax-free. Because each person gets their own £3,000 allowance, you can effectively double your household's tax-free crypto gains to £6,000 just by gifting tokens to your partner right before selling them. Just, make sure you keep a solid paper trail of the transfer.
You definitely want to do this proactively because the penalty regime is totally brutal. If you make an unprompted, voluntary disclosure, you attract much lower penalties. But if you just sit back and wait for HMRC to corner you using their CARF data, they can whack you with up to 100% of the unpaid tax as a penalty, plus daily interest. And if they decide your actions were deliberate and concealed, they can literally backdate their assessments up to 20 years.
So, that brings us to our final thought for this explainer. As decentralized finance violently collides with a very highly centralized tax reality, you really have to ask yourself, is your digital footprint actually as invisible as you thought? The whole era of crypto opacity is totally over. It is time to get your records in order, utilize those legitimate tax-saving strategies like spousal transfers, and take control of your crypto compliance today before HMRC does